Preparing for an Islamic Banking at Qatar Islamic Bank QIB interview. You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What do you know about Qatar Islamic Bank and its business model? QIB is Qatar's largest Islamic bank and a major Sharia-compliant financial institution in the region. Its model is built on deposit-taking, corporate banking, retail banking, treasury, and investment activities structured through approved Islamic contracts, rather than interest-based lending. I would highlight its strong domestic franchise, digital banking push, prudent risk management, and role in Qatar's economy. The key distinction is that profitability comes from asset-backed trade, leasing, partnership, and fee-based structures. While answering, focus on QIB's position in Qatar, its Sharia-compliant banking model, core segments, digital strategy, and how it creates value without conventional interest-based products. Question 2. How is Islamic banking different from conventional banking? The difference is not only avoiding the word interest, it changes how risk and return are structured. In conventional banking, the bank lends money and earns interest. In Islamic banking, financing must be linked to real assets or services, with prohibited elements like riba, excessive uncertainty, and speculation avoided. Contracts such as Murabaha, Ijara, Mudaraba, and Musharaka create profit through trade, leasing, or partnership. That makes documentation, asset ownership, and Sharia review very important. Make sure to cover riba prohibition, asset backing, risk sharing, avoidance of gharar and speculation, and practical differences in pricing, documentation, and customer communication versus conventional banking. Question 3. Explain how a Murabaha financing transaction works for a corporate client. Murabaha is a cost-plus sale, not a cash loan. If a corporate client needs equipment worth QAR 1 million, the bank purchases or takes constructive ownership of the asset and sells it to the client at cost plus an agreed profit margin, payable over time. The profit is fixed up front, so the customer knows the payment schedule. I would be careful to mention sequencing: purchase, ownership risk, sale contract, then deferred collection. In your answer, talk about Murabaha as a cost-plus sale, the bank's asset purchase, disclosed profit margin, deferred payment, and why sequencing matters for Sharia validity. Question 4. What is Ijara, and what risks should a bank monitor in an Ijara facility? Ijara is an Islamic lease structure where the bank owns an asset and leases its usufruct to the customer for agreed rentals. In an Ijara Muntahiya Bitamlik, ownership may transfer at the end through a separate undertaking or sale. From a risk angle, I would discuss asset ownership, maintenance responsibility, insurance through takaful where applicable, and rental collection. In accounting, classification depends on the relevant standards and substance of the arrangement. Be sure to mention asset ownership, lease rentals, usufruct, end-of-term transfer mechanics, maintenance responsibilities, and the difference between Ijara and a conventional interest-bearing loan structure. Question 5. What is the role of the Sharia Supervisory Board in an Islamic bank like QIB? At an Islamic bank, Sharia governance is a control function, not a branding exercise. The Sharia Supervisory Board reviews products, contracts, profit distribution methods, and exceptional cases to ensure compliance with Islamic principles. Internally, Sharia audit and compliance monitor execution, because a correctly approved product can still fail if operations are mishandled. For QIB, I would treat Sharia compliance as central to customer trust, regulatory credibility, and product sustainability. While answering, focus on Sharia governance as an independent control framework covering product approval, contract review, ongoing audit, issue escalation, and customer trust in Islamic banking. Question 6. How would you handle a customer who says an Islamic finance product is too expensive or hard to understand? I would first listen to the customer's concern and clarify whether the issue is pricing, documentation, payment date, or misunderstanding of the Islamic structure. Then I would explain the product in simple terms, including the underlying contract, total cost, and obligations. If the customer is under stress, I would explore approved restructuring or payment support options within policy. The important point is balancing empathy, transparency, Sharia compliance, and credit discipline. Make sure to cover active listening, simple product explanation, transparency on total cost, policy-approved options, escalation when needed, and balancing customer care with risk and compliance. Question 7. What factors would you assess before approving financing for a corporate client? I would start with repayment capacity, not collateral. For a corporate client, I would analyze revenue stability, margins, cash conversion cycle, leverage, DSCR, banking conduct, management quality, and industry outlook. Then I would match the Islamic facility type to the actual business need, such as Murabaha for inventory or Ijara for equipment. Collateral and guarantees reduce loss severity, but they do not replace cash flow analysis or proper facility structuring. In your answer, talk about cash flow repayment, business model, leverage, DSCR, collateral, industry risk, management quality, and matching the Islamic facility to the client's need. Question 8. How does International Financial Reporting Standards 9 expected credit loss apply to Islamic financing assets? International Financial Reporting Standards 9 matters because Islamic financing assets still carry credit risk, even when they are structured through sales or leases. The bank estimates expected credit losses using probability of default, loss given default, and exposure at default. Facilities move from Stage 1 to Stage 2 when credit risk increases significantly, and Stage 3 when impaired. For QIB, this affects profitability, capital planning, pricing, and how early warning signals are managed. Be sure to mention expected credit loss, Stage 1 to Stage 3 classification, significant increase in credit risk, provisioning impact, and relevance to Islamic financing assets. Question 9. Why is liquidity management more complex for an Islamic bank? Liquidity management is more complex for Islamic banks because they cannot simply use interest-based money market instruments. QIB must maintain enough high-quality liquid assets, manage deposit behavior, and use Sharia-compliant tools such as Sukuk, commodity Murabaha placements where approved, and central bank liquidity facilities. The Treasury team also manages maturity mismatches between short-term deposits and longer-term financing. Strong liquidity discipline protects customer confidence and regulatory ratios during market stress. While answering, focus on why Islamic liquidity management is different. Available Sharia-compliant instruments, deposit stability, maturity mismatch, regulatory liquidity ratios, and stress resilience planning discipline. Question 10. What is the difference between Sukuk and a conventional bond? A Sukuk represents beneficial ownership or economic interest in an underlying asset, project, or cash flow, while a conventional bond is a debt obligation paying interest. Investors in Sukuk earn returns through lease rentals, sale profits, or project revenues, depending on the structure. In practice, legal documentation is critical: asset transfer, purchase undertakings, payment waterfall, and default remedies. For a bank like QIB, Sukuk can support investment portfolios and liquidity management. Make sure to cover beneficial ownership, underlying assets, return generation, legal structure, default remedies, and how Sukuk can support bank treasury and investment portfolios efficiently. Question 11. How do Islamic banks treat customer deposits and investment accounts? In Islamic banking, customer funds may be structured as current accounts, savings accounts, or investment accounts, each with different risk and return features. Current accounts are typically guaranteed on demand, while profit-sharing investment accounts participate in returns generated from eligible asset pools. The bank calculates distributable profit, applies agreed ratios, and may use smoothing mechanisms if permitted. I would emphasize transparency, accurate pool allocation, and Sharia-approved profit distribution methodology. In your answer, talk about current accounts versus investment accounts, profit-sharing pools, agreed ratios, smoothing if permitted, risk disclosure, and transparent distribution to depositors regularly. Question 12. How would you explain the importance of digital banking for QIB? Digital banking is important because customers expect speed, security, and self-service, especially in retail banking. QIB has invested heavily in mobile and online services, So I would connect digital transformation to account opening, payments, cards, personal finance, and customer support. The risks are cybersecurity, fraud monitoring, data privacy, and operational resilience. My answer would show that technology is not just convenience. It lowers cost to serve and strengthens customer retention. Be sure to mention customer expectations, mobile banking, process automation, cost efficiency, cyber risk, fraud controls, data privacy, and operational resilience in digital banking services. Question 13. Why do you want to work for Qatar Islamic Bank? I would position my motivation around 3 points: Islamic finance, QIB's market leadership, and Qatar's growth story. QIB gives me exposure to Sharia-compliant products, disciplined risk management, and a digitally advanced banking platform. I would also mention that I value working in an institution where ethics, customer trust, and commercial performance are connected. Then I would link my skills, such as analysis, client service, or controls, to the role. While answering, focus on QIB's leadership, Islamic finance purpose, Qatar market exposure, digital growth, ethical banking culture, and how your skills fit the specific role. Question 14. Which financial metrics would you review when assessing a bank's performance? For a bank, I would look first at profitability, asset quality, capital, liquidity, and efficiency. Key metrics include net profit, return on assets, return on equity, cost-to-income ratio, non-performing financing ratio, coverage ratio, capital adequacy, and deposit growth. For an Islamic bank, I would also consider financing growth by contract type and investment account behavior. The story is not one ratio, it is how earnings quality and risk profile move together. Make sure to cover bank-specific metrics like ROA, return on equity, cost to income, asset quality, coverage, capital adequacy, deposits, liquidity, and why trends matter more than single numbers. Question 15. If you discovered an error in Islamic finance documentation, what would you do? I would not ignore it or try to fix it informally. I would escalate to my manager and the relevant operations, legal, compliance, and Sharia teams, depending on the issue. The priority is to understand whether the contract sequence, approvals, asset description, or customer communication is affected. Then we correct the record, document the incident, assess customer impact, and strengthen controls. In Islamic banking, process integrity is part of product validity. In your answer, talk about escalation, documentation, control mindset, Sharia impact assessment, customer impact, corrective action, and preventing recurrence through stronger operational controls and training. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.